Hi everyone, myself Siddhant and with me Imra, Susanna, Eduardo and Pulkit. We are here to give our presentation on Amazon Incorporation. Our point is to give a financial analysis and insight on Amazon Incorporation. So I'll go with the flow presentation. We'll go with business description, industry overview, then the sales trend analysis, competitive position, financial ratio analysis, then the weighted average cost of capital, risk analysis, environmental, social, and governance, and recommendation. There we follow the references. So I'll just quickly go with the business description part. As we all know that Amazon is a Seattle-based company founded by Jeff Bezos in 1994. Their initial operation was selling the online books, and right now they have varieties of products that been added into their catalog, right from audiobooks, video books, streaming software, electronics and apparels, furnitures, and recently they've added their virtual assignment, that is Alexa. And because due to the diversification of business, because they have been continuously strategizing and re-engineering the process, and they because of their global presence, they are becoming the number one online retailing portals, and they have their competitors right from Walmart, Best Buy, Lowe's, and Home Depot and Flipkart. And now comparing about the industry overview and the sales trend analysis, the company has posted a uh, huge income in the quarter three 2020, and they are expecting the same, that we've been going to outpace the quarter three record in 2020. And coming to the growth analysis, the company has been phenomenally doing because of the COVID-19 outbreak. They're getting a huge response, and the company so in 2019 outpaced the 2018 growth by posting a huge net income growth. And now I'll go with their performance versus their competitors. So coming about the market capitalization, revenues in terms of net income, and number of employees they are employing in their organization is something like tremendously outstanding. And comparing to the other competitors like Best Buy, eBay, GameStop, Staples, Target, and Walmart. I mean, they are not even in the loop to compete with the Amazons, because of their working capital is so strong that they are keep on re-engineering the process and keep on adding the new services. Now, my friend Imra will speak on a financial ratio analysis.
Hi, so speaking about the financial ratio analysis, here we have the financial ratios for 3 years, 2019, 18, and 17. We have the liquid ratio, active ratio, and profitability ratio. Next slide, please. Yeah, speaking about the next slide. Yeah, speaking about the financial ratio analysis based to the benchmark standards of the competitive companies, we have a liquid ratio where the standard is 1 is to 1, and the company's ratio is at a 0.86. Therefore, the company is quite liquid when compared to its competitors. Inventory ratio for the standard ratios is between 4 to 6, and the company has outbeaten the company benchmark at 8.08%. So that means for a company like Amazon, which is a delivery oriented company, having a good inventory ratio is crucial. 8.08 inventory ratio means that the company turnover of stock is pretty high, which is good. Coming to the asset turnover, the standard ratio is between 0.25 to 0.5, and the company stand ratio is 1.25. The reason for such a high company ratio is because this is derived from the Amazon for online uses. Coming to the profitability ratio, the standard ratio is at 33%, and the company's ratio is at 40.99%. Solvency ratio at the benchmark is 20%, but the company's solvency ratio is drastically high at 70%. Now, my friend Pulkit will take over. Thanks.
Yeah, thanks, Imra. So I'll be talking about the company's risk. So when we all talk about Amazon, we all know that Amazon has been always has a high market share price. So even in the pandemic times, their market price didn't decrease; it drastically increased. But as we all know, with such huge margins, the company offer comes with a sets of risk that are associated with the companies. So if I say about investing in Amazon stock, then if I talk about the competitors, uh, like Amazon, by using its AWS, it's 71% of their high profits are coming from their cloud computing technologies. So while I compare with Microsoft and IBM with their Azure or Watson, so I think Amazon is lacking behind, because recently a 10 billion deal with the defense department has been like given to Microsoft, and they have been taken from, they were firstly given to Amazon, but they took it from Amazon and given to the Microsoft. So their market value decreased at a very, like, it almost decreased by 8%. So secondly, if I talk about operation risk, then operation risk, when it comes to operation risk, it's all about the companies which are in retailing and online shoppings. So if I talk about Walmart and Best Buy, then I think they are the best. They are the very tight competitors in this game of online shopping with the Amazon. And recently, the Best Buy and the Walmart, they have started using a online strategy, like for delivering, like free shipping strategy, to overtake Amazon, and they are quite successful. Like in year 2019, the quarter 3 sales of Walmart was like 41% more than the previous year. So lastly, if I talk about the government regulations, so many US and European countries, so they are now having a discussion to stop the Amazon services, or to shut down Amazon services, because they have seen a lot of cases that have been filed with the employee within the employees of sexual harassments and discriminations. So plus many cases have been filed of Amazon delivery drivers regarding accidents and deaths. So this is the reason, like, the government regulations, they have a strict government regulations that can prevent Amazon to, to outrun into all the countries. So this is my part, and thank you so much. I'll pass on into Eduardo for financial ratio analysis.
Thank you, Phuket. So I will talk about the WACC, which is the weighted average cost of capital. So basically, is the rate that a company is expected to pay on the average to all its security holders to finance its assets. So it's commonly referred to as the firm's cost of capital. So importantly, it is dedicated by the external market and not by the management of the business. Here we have the formula that we use it considering the cost of equity, the cost of debt, and the tax rate. So basically, the formula is calculated by dividing the market value of the firm's equity by the total market value of the company's equity, and debt multiplied by the cost of equity multiplied by the market value of the company's debt by the total market value of the company's equity, and debt multiplied by the cost of debt. So here we have the weight of equity, the weight of debt. We took all this information from the reports we use it. So we have the current risk-free rate. Please, the next slide. Okay, on this slide, we have the cost of debt. We did here the calculations to find the latest 2-year average tax rate. We consider the 13.81%. And when we put all this together, we have the 7.71%, and that's the weighted average cost of capital for Amazon. So now I'll pass to my colleague to talk about the last part.
Okay, so I will be speaking on the topic companies, environment, and sustainability. Amazon has been continuously assessing their ESG performance, that is environmental, social, and governance. The company strives to work towards the preservation of environment, and it has been constantly involved in the CSR activities, that is corporate social responsibility. And Amazon has been strictly adhering to the regulations and meet their audit objectives in case of financial matters. Next slide, please. Some of the recommendation for the company. The company needs to address the dividend growth model, which will help in knowing the constant growth rate of the company. It should be more focused on stakeholders assessment, as it will help in removing the multiple barriers for the progression of the company. It needs to strategize in increasing asset turnover ratio so that the company can be more efficient, and it should be lowering equity debt ratio and increasing the current ratio, which will attract more investors. And the next slide is the references. Thank you.
All right. Thank you, guys.
Okay. Thank you, guys. It was great working together.
Thank you.
Thanks all. Bye.